PulteGroup's Q2 2026 earnings just hit the tape, and they missed consensus on the top line.
Yeah, they really did.
Earnings per share came in at $2.48, and that is down from $3.03 a year ago.
Right. And home sale revenues landed at $3.8 billion, which is a fairly steep, 11% year-over-year decrease.
Exactly, 11%. And the stock took a slight dip in early trading as the market, digested those misses.
But following up immediately on those headline results, their Q3 2026 guidance is projecting home closings somewhere between 7,000 and 7,400 units,
Okay.
with gross margins expected to land between 24.5% and 25%.
Which is pretty solid.
Yeah, and if you look at the full year 2026, management is forecasting 28,500 to 29,000 closings. And that's supported by a massive $5.4 billion targeted specifically for land spend.
So you look at those numbers on the surface, right? Revenue is down, earnings are down, they're basically selling fewer homes.
Yeah.
But here's the paradox we're going to unravel for you today. While the raw volume is shrinking, their profitability trajectory is actually stabilizing.
Right, which sounds counterintuitive.
Exactly. And they are generating more cash than they seemingly know what to do with. So how does a company make a better margin while moving fewer, cheaper units?
It's the big question.
We are going to tear apart PulteGroup's segment performance, analyze their margin dynamics, get management's read on the macro environment, and look at a very unexpected risk factor they just dropped into their SEC filings.
It really is a fascinating case study because, looking at a home builder's earnings isn't just about the company itself, right?
Right, it's bigger than that.
It's a real-time thermometer for the entire U.S. economy. You see exactly how the American consumer is reacting to interest rates, inflation, affordability, all in real time.
Yeah, so let's start right at the top line with that 11% drop in revenue. We need to figure out exactly what combination of volume and pricing caused that revenue to contract.
The mechanics of it.
Right, so digging into the actual data, their home closings fell 8% year over year.
Yay.
That brings them down to 6,997 homes actually completed and handed over to buyers.
Under 7,000.
Yeah. And concurrently, the average sales price, the ASP, dropped 3% to $544,000.
So they're getting hit on both sides.
Exactly. We have a dual drop, lower volume, and a lower average price. Now, when I see that in a retail context, my mind immediately goes to, a department store desperately trying to clear seasonal inventory.
Oh, like the winter coats in April?
Yes. They are slashing the price on the winter coats, but the foot traffic just isn't in the mall, so they are still moving fewer units overall. So my question is Pulte just sacrificing their price integrity to maintain a baseline heartbeat of sales?
It's tempting to look at it that way, but the department store analogy actually breaks down when you look at how a modern home builder operates.
Oh, really? How so?
To understand what's really happening, you have to look at the commentary from PulteGroup CEO Ryan Marshall. He was incredibly upfront on the earnings call.
Okay, what did he say?
Well, he noted that overall market conditions remain, quote, highly competitive. He pointed directly to macroeconomic uncertainty, volatile interest rates, and, strained affordability as the primary weights keeping buyers out of the market.
Right, the usual suspects?
Yeah, but they aren't treating their homes like clearance coats on a rack. They aren't just engaging in a nationwide fire sale to force volume.
Right, they aren't sending out a national email blast saying 10% off every house in America this weekend only.
Exactly, no. Marshall emphasized that they are making highly tactical adjustments. They are actively working to balance price and pace on a community-by-community.
Wow, really hyper-local.
Almost street-by-street basis.
Yeah.
The goal for Pulte isn't just to move units at any cost. It's to support high enterprise returns.
So they're being picky about where they take the hit.
Yeah, you have to think of it more like dynamic pricing for an airline seat.
Oh, that makes sense.
In a market where a 7% mortgage rate is keeping buyers on the sidelines in, say, Austin, Texas, Pulte might surgically adjust their pricing and incentives in that specific zip code.
Just to find the exact clearing price.
Exactly, where demand meets their return thresholds.
Yeah.
Meanwhile, in a different market, like somewhere in Florida, they might hold the line on price entirely.
Got it. And that dynamic pricing strategy naturally brings us to the profitability side of the equation, because if you are dropping prices in certain markets just to maintain your pace of construction, the logical assumption is that your profit margins are going to get crushed.
Right, that's what you would assume.
And this is where the quarter gets incredibly interesting. Pulte's home sale gross margin came in at 25.0% for Q2.
Which is solid.
It is. Now, on a year-over-year basis, yes, that is down. It's down 200 basis points from Q2 of last year when it sat at 27.0%.
Yeah.
But And this is the crucial part for your portfolio analysis, it actually represents a 60 basis point sequential increase from the first quarter of 2026, which was at 24.4%.
And that sequential improvement, measuring Q2 against Q1 of the same year, is arguably the more critical metric for you to watch right now.
Why is that better than year over year?
Because comparing margins to a year ago can be misleading. A year ago, the entire interest rate environment and consumer psychology were completely different.
That's a great point.
Sequential margins show you the immediate trajectory of the business operating within the reality of today's market. And going from 24.4% to 25.0% shows they are gaining efficiency.
I hear you. But I want to push back on that efficiency narrative for a second because I'm looking at their incentive data and I see a contradiction.
Okay, let's hear it.
Let's look at the costs they are eating to get people into these homes. Current period incentives, meaning the cash Pult is spending to buy down mortgage rates for buyers or offer free upgrades, were 10.4% of the sale price.
It's a big chunk.
It is. That is up significantly from 8.7% a year ago. Now, it is slightly down from 10.9% in Q1, but it's still elevated. At the same time, their selling, general, and administrative expenses ticked up to 10.1% of revenues, which, mathematically makes sense. If your total revenue drops 11%, those fixed corporate costs take up a larger slice of the pie.
Right, exactly.
So let me float a theory here. With year-over-year incentives way up and overhead costs taking a bigger bite out of the lower revenue base, but margins still improving sequentially from Q1, it seems like management basically took their medicine early in the year.
Oh, I see where you're going.
Yeah, did they dump all their aggressive discounting into Q1 to clear the backlog? And now the worst of the margin compression is in the rearview mirror.
The data absolutely supports that theory. Management's ability to drive that sequential margin beat wasn't some accounting trick. It was pure operational execution.
So they just got better at managing costs.
Yeah, they managed their raw material and lot costs effectively, and as you noted, they were able to dial back those sales incentives just a hair from Q1. This perfectly illustrates what they call their return-focused operating model.
So they front-loaded the pain.
Exactly. They absorbed the pain of higher incentives early in the year to ensure the pipeline of construction didn't stall out.
Because stopping is the worst thing you can do.
A stalled pipeline is a death sentence for a home builder because the holding costs will bleed you dry. Now that the pipeline is flowing steadily again, they are finding efficiencies and stabilizing the ship.
And we can't talk about their profitability without mentioning their in-house financial services arm.
Huge driver.
Their financial services pre-tax income dropped slightly to $37 million for the quarter, but their mortgage capture rate remained rock solid at 85%.
That's incredible.
Right. That means 85% of the people buying a Pult home are also getting their mortgage directly through Pult. That seems like an absolute superpower in a high-rate environment.
It is a massive defense mechanism. By keeping the financing in-house for the vast majority of their buyers, Pult has so many more levers to pull to solve the affordability crisis for the consumer.
Because they control the loan.
Exactly. Instead of lowering the actual base price of the house by $30,000, which ruins the comparable sales values for the rest of the neighborhood.
Oh, it makes all the neighbors mad.
Exactly.
Yeah.
They can use that same money internally to buy down the buyer's mortgage rate from 7% to 5.5% for the first 2 years.
Which is what the buyer actually cares about,
Yeah.
the monthly payment.
Right. It gets the buyer a monthly payment they can afford, it keeps the neighborhood home values up, and it keeps the profit in-house.
Okay, so the margins tell us a great story about the homes they have already finished and sold. But to gauge where the stock is heading, we have to look at the forward indicators to judge their future cash flows.
Right. The leading indicators.
And looking at the Q2 report, their net new orders were a definitive bright spot. They increased 6% over the prior year, taking orders for 7,536 new homes.
But we have to look at the mechanics of how they achieved that 6% growth. Because it wasn't necessarily that demand for housing suddenly spiked.
Wait, really? What was it?
That order growth was largely driven by an 8% increase in their community count. They averaged 1,074 active selling communities in the quarter.
Ah, okay, so they aren't necessarily selling more homes out of a single neighborhood. They're just opening up more neighborhoods.
Yeah, they're casting a wider net.
Opening more storefronts, basically.
Precisely. They're opening more storefronts, so to speak, in different geographical locations to capture the existing demand.
And it seems to be working. The total dollar value of those new orders rose 5% to $4.1 billion.
That's serious backlog.
Yeah, their total backlog, which is homes ordered but not yet closed, is currently sitting at 10,966 homes. That represents a $6.8 billion revenue cushion sitting in the pipeline.
And remarkably, their cancellation rate held perfectly steady at 11%, which is exactly in line with Q2 of last year.
Wow, so buyers aren't backing out.
No, despite all the macroeconomic anxiety, once a buyer signs a contract with Pulse right now, they are actually staying in the boat.
But I want to shift from the pipeline of buyers to the actual pipeline of dirt because their land strategy is fascinating. Pult controls 228,000 lots right now.
That's a lot of land.
It is. But crucially, 55% of those lots are held via option. To put that in perspective, they invested $1.4 billion in land acquisition and development just this quarter.
Right.
I look at this 55% option land strategy as the home building equivalent of just-in-time manufacturing in the auto industry.
That is a brilliant way to conceptualize it.
In the auto industry, a plant doesn't buy a million steering wheels and leave them sitting in a warehouse rusting.
Right, tying up cash.
They have the supplier deliver the steering wheel exactly when the car is rolling down the assembly line. Pult is doing the same thing with land. They aren't buying 228,000 lots outright.
No, they're not.
They're buying the legal right to purchase the land at a fixed price in the future. They only actually buy the dirt right before they are ready to pour the concrete foundation.
And if you are evaluating home builder stocks, you have to understand why that mechanism is so vital. It is the ultimate risk mitigation tool in what is historically a violently cyclical industry.
Because of downturns.
Exactly. Think back to the 2008 housing crash. Why did so many builders go bankrupt?
Because they own all their land outright.
Yes. When the market stopped, they were left holding billions of dollars of rapidly depreciating dirt on their balance sheets while still paying property taxes and interest on the debt used to buy it.
But with an option, if the market tanks tomorrow, Pult can just walk away. They lose their initial deposit, sure, but they don't take the catastrophic loss on the actual land value.
Exactly. This capital-efficient land pipeline is how Pult underwrites against downside risk. And the secondary benefit is that it massively boosts their profitability metrics.
How so?
Because they are not carrying the full weight of 228,000 lots on their balance sheet, they can consistently target a top quartile return on equity, or ROE. And the proof is in the numbers their ROE currently sits at a trailing 12-month rate of 14.8%.
Because the math of ROE is just net income divided by shareholders' equity, if they owned all that land outright, the equity denominator in that calculation would be massive,
Right.
which would drastically drag down their overall return percentage.
You've got it. It's a strategy designed to generate the highest possible returns while tying up the least amount of cash.
Which begs the obvious question regarding their capital allocation. If Pult isn't tying up all its cash in owned land, what exactly are they doing with it?
Good question.
Looking at the report, their balance sheet is almost startlingly pristine. They ended Q2 with $1.4 billion in pure cash and equivalents.
Very healthy.
Their leverage is highly conservative. They have a debt-to-capital ratio of 12.3%, and when you factor in their cash, the net debt-to-capital ratio is just 3.3%.
That is practically zero debt for a massive industrial operation.
Right. And what they are doing with that excess cash is aggressively buying back their own stock. In Q2 alone, they repurchased 3.1 million shares for roughly $373 million. Year to date, they've repurchased 5.5 million shares. They've literally retired 3% of their entire outstanding share count in just 6 months.
That is aggressive.
Now, I have to ask the cynical analyst question here. Is an aggressive share repurchase program actually a red flag? Does this signal that Pult lacks attractive new markets to expand into? Like, are they out of growth ideas, or is this just a flex of how much excess cash their business model generates?
It's a very fair critique to raise. And it's something you should always ask when management teams start buying back huge chunks of stock.
Yeah.
But in Pulte's case, I would point you directly to their stated value creation formula. Their model isn't choosing between growth or buybacks. It's explicitly designed to do both.
At the same time.
Yes. They generate such robust cash flow through that disciplined, option-heavy land strategy and their integrated build process that they can play offense and defense simultaneously.
Because they did state they are targeting $5.4 billion for land spend this year.
Precisely. They are funneling over $5 billion into land acquisition and development. That is massive organic growth. They are reloading their assets and preparing for the future.
So they're not sacrificing growth for buybacks.
No, the reality is the business simply generates far more cash than they actually need to fund that aggressive growth. So rather than hoarding it or making risky acquisitions outside their core competency, they are routinely returning those excess funds to shareholders.
That makes sense.
When they retire 3% of the outstanding shares, your fractional ownership of the company and your claim on its future earnings mathematically increases without you having to buy another dime of stock.
Right, your slice of the pie just gets bigger.
Exactly. With $1.8 billion still remaining under their current share repurchase authorization, it is absolutely a flex of their cash generation capabilities, not a lack of internal growth options.
Okay, so we've established a fortress balance sheet, solid forward orders, and a business model throwing off cash. But if you are holding the stock, you can't just look at the rosy metrics.
Definitely not.
We have to adjust the stated risk factors to get the full picture of the road ahead. Now, CEO Ryan Marshall did strike an optimistic tone, stating he sees early signs that conditions may be stabilizing in select geographies around the country.
Which is good to hear.
But when you read past the quotes and dig into the actual forward-looking risk factors printed in this SEC release, the list is extensive.
They usually are.
Yeah, they cite the potential for inflation or deflation, constraints on the availability of mortgage financing, chronic supply shortages for building materials, and local building moratoria.
Pretty standard stuff.
Frankly, that is standard macroeconomic boilerplate for a builder. But there was one specific risk factor they added that stopped me in my tracks.
Let me guess. Artificial intelligence.
Yes, artificial intelligence. They explicitly cite rapidly changing technological developments, including but not limited to the use of artificial intelligence in the home building industry as a formal risk factor.
Yeah, that was a highly notable addition to the disclosures this quarter.
It is wild to me that a brick-and-mortar hammer and nails industry that literally builds physical shelter in the dirt is actively modeling AI disruptions into their SEC risk disclosures. Like, how exactly does an AI build a house?
Well, it doesn't swing the hammer, obviously.
Right.
But what this signals is a management team that is looking well beyond the next interest rate decision from the Federal Reserve. The disruption of AI in construction isn't about robots framing walls. It's about the back-end logistics that dictate profitability.
Like what, specifically?
Think about AI being used to optimize global supply chains, so materials arrive perfectly on schedule, completely eliminating holding costs.
Oh, wow.
Or generative AI altering architectural design software to compress the pre-construction timeline by months. Or even predictive algorithms mapping out future demographic shifts to determine exactly which zip codes to buy land in 10 years from now.
So the risk isn't that AI replaces the builder. The risk is that a competitor figures out how to use AI to shave 5% off their costs, and suddenly Pult's pricing power evaporates.
Exactly. In a highly competitive, margin-sensitive market like housing, falling behind on a technological efficiency curve can be just as damaging to your bottom line as misjudging a local land purchase.
That is fascinating.
Pulte is signaling to you that they recognize the landscape is fundamentally shifting, and they're watching it closely.
So let's bring all these threads together and summarize exactly what this quarter means for you as an investor tracking PulteGroup. Yes, they took a year-over-year hit on both revenue and EPS in Q2.
The top line definitely contracted.
But when you look under the hood at the mechanics of the business, it's a remarkably strong picture. Their sequential margin expansion shows they are regaining pricing efficiency.
Yes, absolutely.
They have a fortress balance sheet with incredibly low net leverage, and they are utilizing a highly capital-efficient, option-based land strategy to protect their returns.
Now, don't forget the orders.
Right. Add in a 6% bump in net new orders, and you see a company that is successfully navigating an exceptionally volatile rate environment.
They're executing their tactical adjustments on a community level, managing their lot costs strictly, and aggressively returning excess capital to shareholders through buybacks while still funding their future pipeline.
Yeah.
It's a masterclass in cycle management.
It really is. But I want to leave you with a final provocative thread to pull on regarding Pulte's specific demographic mix, because this might be their hidden moat.
Okay, I'm intrigued.
If you look at their brand portfolio data from the sources, a full 22% of their 2025 closings were specifically targeted at the 55-plus demographic. Think of their massive Del Webb communities.
Oh, right, the active adult community.
Exactly. And the average sales price for that older demographic was a hefty $597,000, which is significantly higher than their company-wide average.
That's a premium product.
It is. So given the strained affordability mentioned by management today, how much will this specific, often cash-heavy, older demographic insulate Pulte from future mortgage rate shocks?
That's a great question.
Because if you are a 60-year-old buyer who has already accumulated a lifetime of equity from a previous home sale, a 7% mortgage rate doesn't price you out of the market the way it completely paralyzes a first-time millennial buyer.
Not at all.
As you evaluate home builders for your portfolio, it's worth considering how that specific demographic insulation might give Pult a unique advantage over builders who are overly exposed to entry-level buyers.
It's definitely something to watch.
Thank you for joining us as we unpack the mechanics behind this quarter's numbers. Make sure you hit follow on the show for our daily earnings coverage, where we do the heavy lifting to keep you well informed on the market.